You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. Guys, time is running out to make a good deal happen because of this one factor. This is an exciting episode. Guys, we're going to break down some strategies that are going to help you to insulate your risk, increase your certainty, increase your profitability so that maybe you make fewer bets, but the bets that you make are extremely, extremely profitable. So the market is all about risk and uncertainty. Here's what the market loves. Think about a company, stocks are probably the easiest way to see the value today of a company. And the value is fluctuating because the market can in real time sell or buy, and they can move that price up and down. And you can see what the market thinks this company is worth in real time. And companies trade on multiples of their revenue or multiples of their net profit. And when you see something that is low risk, a company that is low risk and low uncertainty, that is a very, very expensive stock because the stock market loves those. Investors love those. People love those. Think about an example of a low risk, low uncertainty stock. Coca-Cola, right? Coca-Cola, everybody drinks Coke. Coke is there. It's low risk. They've got a huge market footprint. Their revenues have been solid and steady for decades. I mean, they've been around, 80 years. Massive company, but not necessarily a cheap stock to buy. You think about like Geico or even Berkshire Hathaway, right? Low risk, low uncertainty, very, very expensive. So let's translate that to apartment complexes. What would you say are a low risk, low uncertainty apartment complex or piece of real estate? Well, where is the market placing a premium? So you may think right off the bat, Miami, Florida, Charlotte, North Carolina, Austin, Texas, Washington, D.C., these hotbeds where there's a lot of economic growth, there's a lot of people there, there's a lot of population growth. And so that tends to have less uncertainty and less risk. And so Class A apartments, brand new stuff, built in the best markets that are filled up, they can sell it a 2 or a 3 or a 4 cap rate, where they're selling it 20 to 30 times a multiple of their net profit because there's such little risk and uncertainty in a deal like that. But guys, these are not the deals that I want to buy. These are not the deals that you want to buy. Whether it be the stock market, whether it be real estate, you don't want to buy something that is overpriced. And whenever there's very, very low risk and there's very, very low uncertainty, you are going to be paying a premium for that. So what are the 4 quadrants that these deals can fall into? And what's the one quadrant that we want to buy in? Because there's only one that fit the criteria that I'm looking for, where I can have mitigated risk and outsized returns. How do we identify that? And where should we be looking? And what makes up those deals? So let's get into it. Guys, what makes a depressed price? What creates a depressed price in real estate? What creates a depressed price in a company, in a stock? Well, there's high risk and low uncertainty. That's number one. If this is a high risk, but maybe it's a low uncertainty, then that's going to create a depressed price because there's high risk. What is risk? Because risk and uncertainty are very, very different things. Okay, so risk could be the market, right? Maybe it's not a great market. It's a tertiary market. It's a declining market. Maybe it's not a landlord-friendly market. Maybe it's really, really hard to evict tenants in that market. Maybe the taxes are high. Maybe the insurance rates are high. Maybe the tenant base is not good, like it's all HUD or Section 8. Maybe there's a lot of crime in the area, right? The neighborhood can be filled with crime, and you're going to be dealing with that. Maybe the building is really, really old. It's built in the 1940s or 50s or 60s. So there's high risk of CapEx repairs and plumbing going bad, air conditioners breaking. These are in the high risk category, okay? And so the uncertainty category is very different. So uncertainty sort of looks like risk, but it's different. Here's some examples. So uncertainty could be, one-off events. So let's say Coca-Cola, let's say somebody poisoned a batch of Coca-Cola. They poisoned 1,000 cases of Coca-Cola, 10 people died, hundreds of people got sick, huge PR nightmare for Coca-Cola. What do you think is going to happen to that stock price? Going to tank, right? However, is it really high risk? Well, the infrastructure of Coca-Cola is still there. Their distribution networks are still there. I mean, a great example, real time, is Bud Light, right? So Bud Light embraced the transgender movement. They had Dylan something who was out there promoting Bud Light, and they really upset their customer base. And so Bud Light sales went down, prices went down. Their stock price went down. It was a huge faux pas, marketing faux pas, right? But is Bud Light a bad company? I don't know. I'm not telling you to go buy stock in Bud Light, but I'm just saying that is more of an uncertainty, right? Where it's uncertain. Is Bud Light going to recover from this? Is Coca-Cola going to recover from this if they got thousands of their Cokes poisoned? Those are more uncertainty events, one-off events that are really, really influencing the market's perception of this deal, this stock, this apartment complex, whatever it is. It could be a hurricane, right? A one-off hurricane that came through and smacked the area. And now everyone's like, oh, this is a hurricane-prone area. But it was really just a one-off event. Maybe the vacancy on the property is high. Well, is the vacancy high because the market area vacancy is high and you can't overcome that? Or is the vacancy just high because it was a bad manager and they weren't running ad specials and they weren't leasing it, and they weren't marketing it? And that's just something that you can fix. But because of the high vacancy, it's perceived as high risk. Was there a fire? Did half the units burn down? They got insurance money. They're trying to rebuild them, but now they've got a big vacancy issue. Interest rates are also an uncertainty piece, right? Where the interest rates are and where the debt are. Well, is that going to be forever? Are those rates going to be high forever? Is that something that's definitely risk, or is it more falling under the uncertainty category? The economic outlook. Right? Do we feel like we're going to be maybe going into recession? Are we in a recession now? Well, will we always be in a recession? Will that get better? Will we be able to catch up? Because once the market sees that the uncertainty has faded, well, then the prices come. We saw this in real time in COVID. March 2020, 2 weeks lockdown, we're shutting businesses down. They kept extending it. Well, 3 months into that, there was a extreme level of uncertainty. How dangerous is this virus? How scared should we be? How long is this going to go? Are people not going to pay their rents and apartments are going to go to zero? Are businesses going to shutter and never reopen? A lot of uncertainty in the market. But as we saw, okay, wait a second. All right, we found out that the virus isn't that dangerous. Okay, now we came out with a vaccine. Now we've got social distancing, people wearing masks. Okay, life is going on as usual. Oh, look, the government's dropping helicopter money on everybody. They're printing money. They're offering assistance for people that can't pay rent. And as that uncertainty faded, what happened to the stock market? What happened to real estate? It boomed, right? Because they realized, okay, wait a second, these aren't exactly high-risk companies. There was just a lot of uncertainty in the market, and the market hates that, so they fled. And so prices got depressed. And this is why I say you don't want to be buying a low-risk, low-uncertainty deal because there's no spread to be made. There's no arbitrage to be made. There's no value to be appreciated. There's no profits in that, or very, very little, minimal profits. But you don't want to take on high risk. So the worst kind of deal would probably be high risk, high uncertainty, where you've got a thing that falls under these high risk things, like they're in a bad market, the taxes are high, the insurance is high, the tenant base is crap, the state laws aren't friendly, it's an old building, and they've got a lot of vacancy on top of that, et cetera. Why would you do that deal? Just because it's cheap, it still is high risk and high uncertainty. It's really not good, and it's not going to get better. You want to identify opportunities that are going to get better. And that falls to the third quadrant, right? So first quadrant, low risk, low uncertainty. We don't want those deals. High risk, low uncertainty. We don't want those deals. High risk, high uncertainty. We definitely don't want those deals. Low risk, high uncertainty. This is where the money is made. These are the opportunities that can be uncovered, and this is where people make major wins. I saw on the CoStar website, CoStar is a real estate website, front page, an investor just bought a core office building in downtown Chicago, in one of the best areas of Chicago, a 12-story high-rise building. He picked it up for $4 million. $4 million. A property that is, pre all this craziness with office space and COVID and the economy and the credit tightening, was probably trading at $20 to $30 million. He picked it up for $4. This is a guy that sees there's a lot of uncertainty in the office space. There's a lot of uncertainty in commercial real estate. However, if my basis in this is $4 million, that's a low risk bet. The land alone is worth $4 million. I could ground lease this. I could repurpose this. I could turn this into apartments, condos. I could rezone it. I could do, retail. Whatever he's going to do with it, I don't know. But I promise you the guy's got a plan, and he came into a low risk deal that had high uncertainty. And a few years down the road, he's probably going to look pretty damn smart. Okay, so let's talk about low risk and high uncertainty. These are the deals that you want to buy. Look at something that has intrinsic value. Can you get the intrinsic value or below the intrinsic value? What is that asset worth? The land, the sticks, the bricks. And can you buy it at that price or a discount? So let me give you an example. Columbia, South Carolina, 280 units, 75% vacant. You may have heard me talk about this on my social channels. If you're not following me, follow me at JenningsFosterSmithJr.com, or Jennings Foster Smith Jr. is my Instagram handle. But we bought this unit or this deal, and most people would say, oh my gosh, that's a massively high risk. Why? Well, because of the vacancy. And on top of that, there were 2 buildings that had been burned, and they were in the process of being rebuilt, but they weren't rebuilt yet, and so they couldn't be leased. So there's another strike against it. Well, okay, are those really risks, or is that uncertainty? Well, we dug into the deal. Why is it vacant? Is it a bad market? Are the taxes super high? Are the insurances really high? Is the tenant base terrible? Well, not really, because there really was no tenant base there. It was only 25% occupied. Are the state laws unfavorable? Are the buildings really, really old? What's the vacancy rate of Columbia, South Carolina? And as we dug into those things, hey, this is a good market. This is a landlord-friendly state. The taxes are low. The insurance is reasonable. The age of the buildings was built in the 80s, so that's new enough for my comfort level. And the group that was doing this deal had purchased a 300 unit literally 7 minutes away, the same issue, 75% vacancy, and had taken the vacancy from 25%, or the occupancy from 25% up to 70% in 7 months. So we knew the demand was there. We knew that this was an uncertainty created by the prior ownership group. This was uncertainty and vacancy created by the management group. This was not in a bad area. This was not a bad property. This was not tons and tons of deferred maintenance. In fact, there were 90 units already renovated that all we had to do was onboard them and put people in it. The other thing is our basis in that deal, $16.8 million, was essentially the courthouse steps auction value. So worst case scenario, even if we could only get the occupancy up to 50, 60%, we could probably sell it for more than we paid. And so if we flip that coin and we lose, right, it comes up tails. Well, we either don't really lose anything or we lose very, very little. But if we flip that coin and it comes heads up and we can get it to 90% occupancy and we can rent those units at $1,000 a month, and units in Columbia are trading at $90,000 to $100,000 a door conservatively, that property's worth $28 million, and our cost basis after renovations and all is around $19 to $20 million. And there's an $8 million delta there, an $8 million cushion to mess up. So even if we sell for $25 million or $22 million, we're still in the black. These are the kind of assessments where it's like, this is a low risk deal, but it is very, very high uncertainty. Not many people are going to want to tackle a project like that. Not many people are going to want to step into that because they perceive so much risk and there's so much uncertainty. And so the market really was not too interested in that deal, which gave us the opportunity to come in there and buy that. Let's talk about another example of a low risk, high uncertainty deal. Barberton, Ohio. It's a small town in Ohio, and there was some uncertainty. A good bit of uncertainty, but not a ton of risk. This is a blue-collar town. Population's not huge. It's definitely not a primary market. However, population was stable. People weren't really leaving that place. They weren't growing a whole lot, but they weren't leaving. We saw that the tenant base was being rented at $650 a month, whereas the market rent was like $800. So these are some things that are perceived by the market as risk, but they're not really. It was inherited. The guy's son inherited it when his dad died. He didn't want to manage it. He wasn't managing it well. And so he kept it full and it was in decent shape. The bones were good. It was in a decent market. And we knew that we don't have to push rents crazy. We just have to get what everybody else is getting. Can we get what everybody else is getting? Yes, we can. If we get what everybody else is getting, will that increase the value of the building? Yes. Is the cap rate super low in this market? No. But even at a 7.5 to 8 cap, in filling this unit up at the market rent, we're able to take the value of that building from $1.26 million, which is what we bought it at, to $2.2 million. Create $940,000 in value in 18 months by taking on a low risk but high uncertainty deal. The uncertainty was, can you really get 800? Is this really a market that you want to be in? There's not a whole lot of appreciation in this market. And yet the risk, we picked it up for $40,000 a unit, guys. $40,000 a unit, something that you can rent for $800. Would you buy a single family rental home for $40,000 that was in good shape that you could rent for $800? Absolutely, all day long. And when I looked at that, I was like, okay, the downside on this, if we flip the coin and it comes up tails, would we be able to exit this for $1.2 million? Most likely, yes. Would we get hurt? Probably not. Maybe worst case scenario, we lose $100,000. Are we going to go catastrophic, get foreclosed on, lose everything? No. We locked in a 5-year loan at a fixed interest rate of, I think, 5%. And so our risk level on that deal is super low. And this is what you want to find. Low risk deals with high uncertainty. So when you're looking at a deal, or you're looking at a stock or a company, whatever you're doing in your life, investing, is there just a lot of uncertainty but low risk? Is that why it's priced cheap? Is that why you can get a good deal on it? Is it low risk and low uncertainty and you're just trying to push and pay too much? Because you do that, you're not going to do that. Is this a deal where, hey, it's a cheap price, but it's high risk? It's high risk and high uncertainty, or even high risk and low uncertainty. You don't want to get into those high risk deals where you're getting into a deal with components that you cannot change, right? You can't change the market. You can't just hope that the market's going to get better. If it's a declining market, that is a high risk component. I pretty much run away from deals like that. Are the taxes super high? Are the insurances super high? Is the state not going to allow you to evict people when they don't pay? And it's going to be a 6-month or 12-month process to get somebody out, like it is in California, New York, and Chicago. Well, that's pretty high risk. I want to run away from that. Is this thing built in the 40s or 50s and it's just going to be a capital expense nightmare? Every time you turn around, something's breaking. You got asbestos. You got failing sewer lines. You got crumbling parking lots. You got leaking roofs. All that takes so much capital to keep up with that it just increases and levels up the risk of the deal. So getting into something that you can identify, this is not a risky deal, it just has a lot of uncertainty, that's where you win. That's where the money is being made. And guys, going back to time is running out to make a good deal happen, we are in a high uncertainty environment right now. Let me repeat that. We are in a high uncertainty market right now, and it is evaporating quickly. If you want to roll back the clock to June, July, August, September of 2023, we were probably at the peak of uncertainty. You may remember, maybe you've already forgotten, but the Fed started raising rates 25 and 50 basis points at a time every time they met. We were very, very scared. And I'm saying that as a market, we didn't know where it was going to end. Are they going to take interest rates to 8, 10, 12, 14%? When's the bleeding going to stop? Can we get inflation under control? Right? Can we stop? When will rates ever come back down? Will they even stop raising them? But fast forward just 6 months from then. Shoot, less than 6 months from then. The Fed meets in October, November. You know what? We're not going to raise rates. We're just going to stay where we're at. They meet in December. We're going to keep rates where we're at. They meet in January. We're going to keep rates where they're at. Well, actually, I don't know if they've met in January yet, but the consensus now is the Fed is done raising and they're most likely going to lower rates 2 to 3 times, maybe even 5 to 6 times this year. And so that uncertainty around the rate environment and the economic outlook is evaporating. And so the window of time is narrowing. We put our property up for sale in Tulsa, Oklahoma, I think late summer, peak uncertainty season. And guess what? It didn't sell. Even though we had an assumption loan, even though the rates shouldn't have technically affected that deal at all. Well, people are not totally rational. We know this. Human beings don't make logical decisions every single time. And so we got a few offers, low. We countered, nah. They quoted insurance. Oh, the insurance is high. We can't. And we could not get an offer that made sense to our group. Well, today, literally this morning, I get an email from my broker with a letter of intent of a very, very qualified group. They've already got the cash down payment. They can assume the loan. They've got a large portfolio. They want to make a footprint in Oklahoma and Tulsa. And they've offered us $13 million. That's their first offer, and it's higher, significantly higher than anything we got over the last 6-7 months. And this is why I say I can see it in real time. The uncertainty is starting to evaporate in the market because they see, wow, this is not a high risk deal. This is a low risk deal. I can walk into 10 years of fixed interest rate debt at 4.25%, fully stabilized, fully renovated, in a good market, great management company in place, et cetera, on and on, all the positives about this property. And now that uncertainty is fading. And as that deal falls into the low risk, low uncertainty portion of the quadrant, guess what happens to the price? It goes up. And this is what's happening to us. And so we're kind of hanging on. We're seeing what happens. I've got a couple deals for sale. I've gotten offers that would work, offers that would pay off my debt, offers that would make me a profit. And yet we've kind of been slow playing it a little bit just to sort of see if we can get some of this uncertainty to evaporate, move into that quadrant of low risk, low uncertainty, because that's what you want to sell at. You want to sell in that quadrant. You don't want to buy in that quadrant, but when you're a seller, that's where you want to sell. So, because your job when you buy something is to take it from a low risk, high uncertainty deal to a low risk, low certainty deal. That's where the delta is made. That's where the alpha is. That's where the spread is. That's where the profits are. So guys, I hope this has been useful to you. Think about that quadrant when you're analyzing deals, when you're looking at opportunities. Risk versus uncertainty, they're very different things. And you want to identify the low risk propositions, the low risk deals, but they've got a high level of uncertainty, but it's something that will be overcome in time. All right, guys, have a great week. Spend some time to unlock your life. Peace.
This is thepodcastfactory.com.